Welcome. In the last couple of videos, we've been discussing inventory and cost of goods sold. We've covered them conceptually, we've thought about assumptions that we might make with them, and we've pointed out some differences in accounting across the US and international financial reporting standards. In this video, I'm going to do the really easy part. We're just going to do the bookkeeping so we know, once we've thought about all those assumptions and come up with informed decisions, how do we get those on our books? It's easiest to do this with a simple example. Let's imagine that you're a company, I'll say Target, and you're purchasing books that you're going to sell in the future. You pay $20 for each book, and you buy 1,000 of those books. Well, what happens on your financial statements when you do this transaction? It changes your assets. You've taken one asset, cash, and gotten rid of that, and transformed it into another asset, inventory. You can see it here using the balance sheet equation. Our overall asset number hasn't changed at all. The net impact is zero. We've just transformed the composition of our assets. The journal entry is going to show you the same thing. We no longer have cash, and we now have inventory. And just for completeness purposes, here's the T accounts, which again show cash has gone down, inventory has gone up. Now we're going to hold these items, and eventually we're going to sell them. So let's take a look at that transaction. Target sells these books for $30 each. That's great. We only paid $20, and we're going to sell them for $30. So what happens on our financial statements? Well, remember revenue that we did in the last module? We recognize that we have revenue of $24,000. Last time we weren't able to say what the expense was, but now we can say there's a related expense of $16,000, which means we've created net income of $8,000. What's happened on our asset side? Well, we now have cash of $24,000, and our inventory's gone down by $16,000. Notice that unlike when we bought the books, we've got an imbalance here. We got more asset in of $24,000 than we gave up of $16,000. So where did that other $8,000 go? Well, that's that $8,000 net income that we created. And that comes over to our equity account to show that some of our assets came from the fact that we created value in our ongoing interactions with our shareholders. Maybe the journal entry will make this clearer to you. The first part of the entry says, hey, revenue came in of $24,000. There we're saying we've created some value by interacting with our shareholders. What form did that value come in? Cash. The second part of the entry says, what did we have to give up to get that revenue? Well, we no longer have $16,000 of inventory. And what did we use that inventory for? Well, it was a good that we sold. Thus the inventive name, cost of goods sold. For completeness purposes, let's just go ahead and put all of this into the T account as well. I've combined entries 1 and 2. Here's what you should notice. We started with $20,000 in cash going out, and now we've added $24,000 in cash back. We have $4,000 more in cash. We still have $4,000 left in inventory. We've now had revenue and cost of goods sold as well. So at the end of the year, what does this mean? Our assets in total are up by $8,000, a $4,000 increase in both cash and inventory. Our equity is up by $8,000, showing the balance between those. Where did that $8,000 come from? It came from creating value. How did we create that value? Our revenue of $24,000 is greater than our cost of $16,000 that we incurred to generate that revenue. So at the end of the period, our financial statements answer those two big questions that we set up at the beginning of the course. Where do we stand right now? We have $24,000 of cash and still $4,000 of inventory left. What happened over time? We created $24,000 by interacting with our customers, and it only cost us $16,000 to do that, which means net we generated $8,000 more of value. As you can see, the bookkeeping for inventory is pretty straightforward and just helps us understand what's happened in the firm. In our next module, we're going to turn to property, plant, and equipment and think about those more complicated assets and how we use them.